Today's topic is how to trade the two Japanese candlestick pattern or the double Japanese candlestick pattern. And this is the part 3 of how to trade with the Japanese candlestick pattern. In the first part of this tutorial, I introduced you to the Japanese candlestick pattern, and in the second part of this tutorial, we discussed the single Japanese candlestick pattern. Therefore, in the part 3 of how to trade the Japanese candlestick pattern, we are going to dive into the double or the two Japanese candlestick pattern. Before we get started, ensure you are subscribed to this channel and make sure you enable that notification icon so that you don't miss the upcoming tutorial on this channel. Alright, with that being said, let's get it started. So the first candlestick we have on our price chart is the engulfing candlestick pattern. Bearish engulfing candlestick is the selling pattern, and the bullish engulfing candlestick is the buying pattern. Now, what is the bearish engulfing candlestick is all about, and what is the bullish engulfing candlestick is all about? First, we are in an uptrend market whereby the market keeps on going up, and then on this price chart we can see the last buying candlestick on this price chart, which means the price opened at a lower section and then it closed at a higher section. So this shows us this is a bullish candlestick. Now the next candlestick opens on our price chart. Instead of this candlestick to go in an upward direction, it switched the direction of movement and then goes down to give us a bearish engulfing candlestick. So we have the open of the bearish engulfing candlestick at the higher section, and we have the close of the bearish engulfing candlestick at the lower section. So this technically shows us that the sellers are now taking control of the market. The sellers has defeated the last bullish candlestick in this uptrend market. Whenever you see this type of candlestick pattern on your price chart, you should be looking out for possible selling sentiment. And this doesn't mean you just have to sell. There are some factors which have to be in place. For example, for a bearish engulfing candlestick to be a reliable one, it has to form at a resistance structure on the trading chart or at a supply structure on the trading chart. Do not worry for now if you do not understand what support, resistance, supply and demand is all about. We discuss this in the later section of our tutorial. But for now, just know a bearish engulfing candlestick, it's powerful and effective at a resistance or at the supply level in the market. Right now, let's move to the opposite of the bearish engulfing candlestick. The opposite of the bearish engulfing candlestick is the bullish candlestick. So on this candlestick right here, price was going down. A lot of sellers were in the market pushing the price downward, and they suddenly this you can see we have the last bearish candlestick which opens at a higher structure, and then the close went lower to be a lower section, right? So this is the last selling candlestick in this market, and the next candlestick in this market opens at a lower section, and then the buyers got in and they pushed the price upward, thereby they ensure the price to close at a higher section. You can see that. So whenever you see this type of candlestick pattern in your trading chart, it indicates there's a higher possibility for the downtrend to be reversed into an uptrend market. It means the buyers are willing to switch the market from the seller side to the buying side. So this candlestick pattern is reliable, effective if it forms at a support or at a demand zone on your trading chart. Now let's move to the second variation of the two Japanese candlestick pattern in technical analysis. The next double Japanese candlestick pattern on our list is the Darkcloud and the Piercing. Taking a close view on this candlestick pattern, it looks like the engulfing candlestick pattern, right? But it is not. Right now, as you can see right here, we have the buyers in this market pushing the price all the way up, and then we have the last bullish candlestick. Right now, the open of this candlestick opens at a lower section. Right here we have the open at this level, and then the close of this bullish candlestick closed at a higher section, which makes it to be a bullish candlestick. That is the candlestick that supports buying sentiment. Right now, the next candlestick opened, but instead of the next candlestick to open at the close of the bullish candlestick, do you see what happens on this price chart? The next candlestick gapped up higher than the close of the bullish candlestick. So we have the open of this candlestick right here. We expected the price to go up, but this time around the sellers got in and they pushed the price all the way down, thereby ensuring the bearish candlestick closed at the lower section. right? So this is the close. So this candlestick right here, it's different from the normal candlestick we do have. A gap up, it's not something we usually see in the market. Whenever we see this type of action in the market and then the close of the bearish candlestick closes below the midpoint of the first pattern, which is the bullish candlestick, then it signifies a selling sentiment. So for this candlestick to be a confirmed dark cloud candlestick pattern, the second candlestick of this pattern has to close below the midpoint or the half of this bullish candlestick. So where is the half of this bullish candlestick? This is the half. I think the half should be at this level. Am I right? Yes. You can see that. So you can see how the bearish candlestick close below the midpoint of this bullish candlestick. So this makes this candlestick pattern to be a reliable dark cloud, right? So whenever you see the types of price action candlestick on the trading chart, it means the sellers are trying to reverse the bullish trend into a downtrend. And this candlestick, it's effective, powerful, if it forms at a resistance or at a supply zone on the trading chart. The opposite of this candlestick pattern, the dark cloud, is the piercing. So in the case of the piercing, it supports buying sentiment. All right, now let's see what happened on the piercing candlestick. The price was going down, sellers were pushing price downward, and then we have the open of the last bearish candlestick at the higher section, and we have the close at a lower section. Instead of the next candlestick to open at the close of the bearish candlestick, this time around the price gapped lower. So we have the open of the next candlestick of this pattern to be at a lower section and low. So a surprise, or to the surprise of the market participants, the buyers push the price all the way up and they ensure the price closing at a higher section in the market, where we have the close at a higher section. You can see that. So this is a very powerful price action candlestick in the market. And for this candlestick pattern to be confirmed as a reliable piercing candlestick pattern, it has to close above the half or the midpoint of the bearish candlestick. That is the first candlestick of this pattern. Now let's find out the midpoint of this bearish candlestick pattern. So the midpoint of this pattern would be at this level. So this level is okay. This is the midpoint. You can see right now the bullish candlestick close above the midpoint of the first candlestick of this pattern, which is a bearish candlestick. You can see that. So whenever you see this on your trading chart, it means what? The buyers are willing to reverse the downtrend into an uptrend. And this candlestick is powerful if it forms at what? At a support or demand zone on your trading chart. So ensure this candlestick close above the midpoint of the bearish candlestick to be a confirmed and a reliable piercing candlestick pattern. Now let's move on to the next candlestick pattern on our list. The next candlestick pattern on our list is the railway candlestick pattern. The bearish pattern is called the bearish railway, while the bullish pattern is called the bullish railway. As you can see, these candlestick patterns looks like the bearish engulfing candlestick, but it's not a bearish engulfing candlestick. You can see that the price rallied, that is the buyers push price up, and the last bullish candlestick has a close above. This is the open of the candlestick. At the lower side, we have the open right here. And on the next candlestick, we have price opening at the same level of the close of the bullish candlestick. So we have the open of this candlestick. And the bears pushed the price downward. But this time around, the bears didn't push the price to close lower than the opening of the bullish candlestick. So whereby we have the close of this candlestick right here. So the close of the bearish candlestick and the open of the bullish candlestick are at the same distance, or they are equidistant or at the same level. So whenever you see this type of candlestick pattern on your price chart, it signifies a tug of war between the buyers and the sellers. This as well can be related to what we call the Doji candlesticks, right? Because the price opened at a lower section, and then on the next trading period, it closed at the same opening of the bullish candlestick, right? So for you to trade this type of candlestick pattern, the best way to approach this candlestick pattern is to patiently wait for the next candlestick to be a strong bearish candlestick. That means the bearish candlestick that has to open the next period has to be a bearish candlestick that closes below the close of the second candlestick of this pattern and the open of the first candlestick of this pattern, that is the bullish candlestick. So once you see a strong bearish close clearing or closing below the close of the bearish candlestick and the open of the bullish candlestick, then this pattern has been confirmed. And this pattern is reliable if it forms at a resistance structure on the trading chart. It forms near a resistance structure on your trading chart. So you look out to see this pattern at resistance or at supply zones in the market, right? So you have to be very careful if you want to trade this candlestick pattern. Now, the opposite of the bearish railway candlestick pattern is the bullish railway. This time around, the bears push the price downwards, the sellers are pushing the price down, and then we have the open of the last bearish candlestick at the high section. The bears push the price all the way down, and then we have the close of the bearish candlestick at a lower section. You can see that. And on the next period, the buyer set in and they opened the price at a lower section, and they ended up pushing the price at the same level of the opening of the bearish candlestick, whereby we have the close at the same level. So this is equidistant or the same level. So whenever you see this type of candlestick pattern on the chart, it is called a bullish railway, and then it signifies a state of indecision in the market. It signifies a strong or a tug of war between the sellers and the buyers. So the best way to trade this type of candlestick whenever you see them on your price chart is to patiently wait for the next candlestick to be a strong bullish candlestick closing above the close of the second candlestick of this pattern and the opening of the first candlestick of this pattern, which is a bearish candlestick. So you have to wait for the third candlestick to be a strong bullish candlestick closing above the close of the bullish candlestick of this pattern and the opening of the bearish candlestick of this pattern. So once you see a strong bullish or buy candlestick above, then this candlestick has been confirmed. And for this candlestick to be a reliable candlestick pattern, it has to form at a support level, right, or at a demand level on the trading chart. So this is how you trade the railway candlestick pattern. Now let's move on to the next candlestick on the list. The next candlestick on our list is the Tweezers candlestick pattern. As you can see, the Tweezers candlestick patterns looks like the reversal candlestick, which we discussed in the part 2 of how to trade with the Japanese candlestick. So they look the same way, but this time around the Tweezers candlestick pattern has 2 candlesticks to form the pattern, which is called Tweezers top or Tweezers bottom, right? So right here we have the first bullish candlestick. The buyers push the price from the low section all the way up, and then they opened at the lower section. This is the open of this candlestick. The price rallied up to give us a high. Remember, we discussed high in the first part of this tutorial of how to read the Japanese candlestick pattern, right? So we have the high, and the sellers got in at this high, and they resisted the buyers from pushing the price upward, whereby the sellers put the price down, whereby the price closed at the lower section. You can see that. So we have the high, we have the close, and we have the open on this bullish candlestick. Now on the next period, the sellers got in and they opened the price at the close of the first bullish candlestick of this pattern. So we have the open right here, but this time around the buyers got in and they pushed the price up again. They tried to continue the bullish rally. So the buyers pushed the price all the way up, but at this zone right here, what happened next? the sellers got in again and they resisted the buyers. So these actions occurred 2 times for the seller side. Remember, the sellers took action right here, resisting the buyers, and right now this is the second time in this market, right? That is on the second candlestick. So the sellers pushed the price all the way down, and the sellers didn't end at this level. They went further to push the price more lower, whereby the price closed lower. So we have the close right at the bottom. So you can see right there, this shows us technically the sellers are so active in this market and they are doing all what they can to push price all the way down. So this is why this candlestick, it's a very powerful candlestick when you see it in the trading chart, right? This candlestick is powerful, effective if it forms at a resistance structure or at a supply structure on your trading chart. So to trade this candlestick pattern right here, all you have to do is just to look out for the next candlestick to continue to the downtrend, right? So that is all about the Tweezers top, right? So it supports a bearish move in the market, and the opposite of the Tweezers top is the Tweezers bottom. So this time around, the sellers push the price all the way down, and the next or the final bearish candlestick in this market opened at a higher section, and the sellers push the price all the way down. But this time around, when the sellers push the price to this level, right, the buyers got in and they resisted the sellers, right? They resisted the sellers, so the buyers got in and they pushed the price up. So they ensure price closing at the higher level, but this higher level is not above the opening of this candlestick. So whereby we have what we called the lows. Remember, we discussed lows in the first part of this tutorial, right? So we have the low right here, what we call the lower shadow or the lower wick, and the high right here is the upper shadow or upper wick. You can call it high as well, right? Don't forget that. Good. Now we have the lower shadow on the Tweezers bottom. That is the first candlestick of the Tweezers bottom, which is the bearish candlestick. So the bulls or the buyers didn't end at this zone. They got in on the second period, and then they opened the price at this level. We have the open right here, and then the sellers tried to exercise another interest, so the sellers got in, they pushed the price down, and the bulls said, we are not yet done in this market. We are willing to reverse this market to an uptrend market with everything we can, right? So the buyers got in and they pushed the price upward again. But this time around, the buyers didn't stop at the opening of the price level. They went further to push the price at a higher structure, whereby they ensured the price closing at a higher session. So we now have the close above, right? So whenever you see this type of candlestick pattern on your trading chart, it means a lot. It means the buyers are doing all their best to reverse the downtrend to an uptrend, and this pattern becomes reliable, powerful if it forms at the low of a downtrend, and if that downtrend aligns to a technical support or demand zone on the trading chart, right? So this is how you trade the Tweezers bottom. Now let's move on to the next candlestick on our list. The next candlestick pattern on our list is the Harami candlestick pattern. The bearish pattern is called the bearish Harami, and the bullish pattern is called the bullish Harami. So what is the Harami candlestick all about? You have to be very careful before you trade, or whenever you want to trade this candlestick pattern, because it seems like a complicated candlestick pattern, right? So first, on the bearish Harami candlestick pattern, price was coming in a downtrend. So the price is going in an uptrend. That means the buyers are pushing the price upward, and they push the price up to the last bullish candlestick, which we have the open of the bullish candlestick right here. We have the close of the bullish candlestick at the higher section, and the next candlestick of this pattern resulted into a bearish candlestick. That is a seller's candlestick, and this candlestick gap lower. Sometimes this candlestick can open at the exact close of the bullish candlestick, or it can gap lower a little bit, right? So we have the opening of the bearish candlestick at the higher section, and we have the close lower than the open, right? Now this gives us a bearish Harami candlestick pattern. Now for you as a trader to trade this type of candlestick pattern, you need to exercise patience for the next candlestick to close lower than the opening of the bullish candlestick, right? So the opening of this bullish candlestick is at this medium right here. Okay, so we need the bearish candlestick that will form later in this market to clear out the opening of this bullish candlestick. Once you see the bearish candlestick clearing the opening of this bullish candlestick, then this pattern has been confirmed for a downtrend. And take note, this candlestick pattern, it's powerful, reliable, effective if it forms at the resistance of a bullish trend or at the supply level on the trading chart. Right, now let's move to the opposite of the bearish Harami candlestick. The bullish pattern of the Harami is what we call the bullish Harami. On this price chart, price was going downtrend. That means the sellers were pushing the price down, and the last candlestick resulted into a bearish candlesticks. So we have the opening of the bearish candlestick at a higher level. This is the opening, and then we have the close at a lower level. You can see that, and the next candlestick opens to be a bullish candlestick. You know, sometimes the opening of the bullish candlestick can open at the close of the bearish candlestick, or it can gap up a little bit. So whenever you see the bullish candlestick, this gives us what we call the bullish Harami candlestick pattern. This is what you need to do once the opening and the close of the bullish candlestick has been formed, resulting into the bullish Harami. You need to patiently wait for the next candlestick to close above the what? Above the opening of the bearish candlestick of this candlestick pattern, right? So once we have a bullish candlestick, then this candlestick has been confirmed for the reversal of a downtrend to an uptrend. And this candlestick is powerful if it forms at the low of a downtrend. That means it has to form at the support level or at a demand level on the trading chart. Again, listen attentively. Remember, I told you in the beginning, I said this candlestick looks like a complex or a complicated candlestick pattern. The reason why I stated that, it's because this candlestick can also form in other variation on your price chart, right? So instead of having a bearish candlestick for the bearish Harami, this candlestick can decide to have what we call the Doji. So instead of having a bearish candlestick at the second candlestick, it can result into a Doji candlestick. So what you need to do as a trader is you need to patiently wait for the next candlestick to close lower than the what? Than the opening of this bullish candlestick. So it means we have to see a bearish candlestick closing lower for this candlestick to be confirmed for the reversal of an uptrend to a downtrend. Whenever we have a Doji candlestick, it is regarded as a bearish Doji Harami, right? So it is regarded as a bearish Doji Harami. But in the case of a bearish candlestick, it is called a bearish Harami, right? Now, in the case of the bullish Harami, instead of having a bullish candlestick, the bullish candlestick can result in a Doji candlestick. So let's get this off. So for you to trade this candlestick pattern, you have to wait for the next candlestick to close above the opening of this bearish candlestick on your trading chart. Right now, this candlestick, if it has a Doji, it is called a bullish Doji Harami. Right now, we wait for the next candlestick to be a strong bullish candlestick closing above the opening of the bearish candlestick. So this is how you trade the Harami candlesticks. In the next section of this tutorial, which is going to be part 4 of how to trade the Japanese candlestick, I will introduce you to the 3 candlestick pattern or the triple candlestick pattern. Ensure you are subscribed to this YouTube channel, enable that notification icon so that you don't miss the upcoming tutorial. You can as well check the description of this video to access the previous tutorials and the next tutorial. Thank you.